let's move to another concept of warranty. So we've been talking about very different things, right? And that's where it is important. There are multiple scenarios which are out there from a transaction price perspective, right? So is there a variability? Now, why is this important? When there is a variability can be by way of a rebate or a discount. We've talked about that. A variability could be because of a bonus, which is like early completion or incentives, like what I talked about. A variability could also be because of the market factors, right, which we talked about, right, which was this, the portfolio manager fees from that perspective. A variability also could be because of the change in estimates, right, which happened because of change in circumstances, from that perspective. A variability could be because of right of refund. There is a refund clause in the contract. There is a variability because of that. So anything which poses a doubt or poses a challenge to the amount of consideration to which you are entitled for, if that is the case, it is a variability, right? And variability, you got to again eliminate the variability from a revenue recognition perspective to say, is it highly probable? Highly probable is likely to occur. How do you determine this? Based on expected value method or most likely outcome method, right? So expected value method, when you look at the range of possible outcomes, assign the probability and then determine the outcome, from that perspective. Most likely, like binaries, there are two possibilities, and then you try and pick one of them based on your experience. It's a judgment. It's a judgment, but judgment has to be exercised with the caution that it has to be highly probable, which is the expected revenue reversal is not likely to occur. Highly probable means likely to occur. That means the reversal is not likely to occur, from that perspective. Let's talk about warranties, right? Warranties are of two types. From the standard perspective, warranties are of two types. What are the two types of warranties? Assurance type warranties and service type warranties. Okay, there are two types of warranties: assurance type warranties and service type warranty, right? Now, what is an assurance type warranty and what is a service type warranty from that perspective? So if you think about it, the distinction is like this, right? Assurance type warranty, let's say you go and buy a mobile phone, right? When you're buying a mobile phone, the seller has made a promise to you. Look, this is how this mobile will operate. You will get a 2 GB RAM, you'll get 32 GB of storage, you will get the calling, you can do chatting, you can do video, this is the camera, so much, so on, and so this is the software which you're getting, and all of them are supposed to perform to design specification which are promised by the customer. So assurance is that it is going to perform based on the promises which I'm making to you under the contract. It is not to enhance, not to maintain the level of performance, but it is supposed to perform of what I am going to promise to you under the contract, right? Which is called assurance or type warranty. A service type warranty, when I'm helping you to manage the product which you have purchased. For example, if you buy an automobile, vehicle or a car, and then I say, if this car, actually I'm going to give you free maintenance for a period of 3 years, and you can come and get this thing maintained at my, workshop, and then I'm going to do a free service every 1,000 kilometer or every 10,000 kilometer. Now that is called a service type warranty. A service type warranty is a separate performance obligation. An assurance type warranty is not considered as a separate performance obligation. For an assurance type warranty, you make an estimate for the future warranty cost and provide that as a cost in your financial statement. You don't reduce this from the transaction price, okay? But for a service type warranty, you actually reduce it from the current transaction price allocate a transaction price to this additional performance obligation, which is a service type warranty, and record revenue in two different tranches, once the product's been sold and then once the service obligations are getting fulfilled, right? So try and understand this distinction between assurance type warranty and a service type warranty, and we'll further try and understand this with the help of a flow chart. So, let's say you go and buy a refrigerator, right? It says that the condenser will work for 10 years, right? The compressor will work for 10 years from that. You buy an air conditioner and so on and so forth. The many products which we buy, they all come with assurance type warranty, right? That means you don't need to worry. But the moment you buy an extended warranty, that this customary warranty period is 3 years, but I'm going to give you a 7-year warranty period, then in that case the 4 years is what you're getting extra, is no longer an assurance type warranty, is an additional performance obligation. All right. So it's common for an entity to provide, a warranty in connection with the sale of a product. The nature of warranty can vary significantly. Some warranty provide a customer with assurance that the related product will function as the parties intended because it complies with the agreed upon specification. Other warranties provide the customer with a service, right? In addition to the assurance that the product complies with the agreed upon specification. As per Ind AS 115, a law that requires an entity to pay compensation if product causes harm or damages, it does not give rise to a performance obligation. For example, a manufacturer might sell products in a jurisdiction in which the law holds the manufacturer liable for any damages that might be caused by a consumer using a product for its intended purpose, from that perspective, right? So you got to look at all of this in a way carefully. So similarly, an entity promised to indemnify the customer for liabilities and damages arising from claims of patent, copyright, trademark, does not give rise to a performance obligation, right? So let's try and understand some better distinction between an assurance type warranty and service type warranties, right? A service type warranty, customer has the option to purchase. You're buying this over and above the product which you're buying. It's a distinct service. Account is like additional performance obligation. Account for the promised warranty as a performance obligation and allocate a proportion of the transaction price to that performance obligation. Assurance type warranty, customer does not have option to purchase separately. Warranty provides an assurance that the product complies with the agreed upon specification. Account for the warranty in accordance with Ind AS 37, right? From that perspective. So that's how the service type warranty and assurance type. Assurance type, you don't reduce it from the transaction price. You account for this under Ind AS 37 as a cost to fulfill your warranty obligation. If it is a service type warranty, it's an additional performance obligation where you're going to reduce your transaction price or allocate a portion of transaction price to this performance obligation, and this is going to impact the timing of revenue recognition, from a financial statement perspective, right? Let's move on. Let's move on to talk about now another concept called significant financing. Okay. Now, what is significant financing? There are two types of financing, right? Is what you need to be careful about. There are two types, right? In a way, you may receive, let's say, a delayed payment, or you may receive an advance payment, right? If I've received an advance payment, that also has an impact on revenue recognition. If I am going to give extended credit period to my customer, that also has an impact on your revenue recognition. Now, the only thing is that if you're giving an extended credit period to a customer, there is a practical expedient in the standard which suggests that if the credit period is less than 1 year, so to say, okay, within 1 year you're likely to collect, then it is presumed that there is no financing component. But if the credit period in a way goes beyond 1 year, then it is presumed that there is significant finance. And possibly you can apply the same to an advance payments as well, the same analogy, right? To say that if you receive money in advance, within the year of performance, then you are okay. You don't need to worry about this. But if you receive money in advance for more than a year and it is significant in size, then you need to really worry about this. right? From an accounting revenue recognition perspective, and we'll try and understand this. How do we look at some of this perspective, right? So an entity adjust the transaction price for the effect of the time value of money if the timing of the payment provides either party with a significant benefit of financing. The question is that what are you doing, right? Are you selling your product, or you actually, by in the garb of selling your product, you're also doing financing to the customer? Because time is money in end of the day, right? The interest never stops, right? From a commercial transaction perspective. So evaluation is not required if the entity expects the period between the transfer of performance obligation and receipt of payment is 1 year or less. That is the practical expedient. Okay, 1 year, right? Practical expedient. Now, if the financing component is not significant, then it is not required to adjust the transaction price. If it is significant, and again, these are judgments, right? If it is judgment, then I need to adjust it, with reference to the prevailing interest rate in the relevant market, right? From that perspective, and we will try and understand some of this with the help of some example. If a customer has paid in advance, or a substantial amount of the consideration is variable, why are they paying in advance, why are they delaying the payment? All of this is what I need to look at, right? A contract would not have a significant financing component, right? Customer paid in advance, but this is at the discretion of the customer. Customer says, look, take this money, I want to take delivery as and when I want to take delivery, then there is no financing involved, right? A substantial amount of the consideration is variable, and the amount of timing varies on the future event that is not substantially within the control of the customer of the entity. I think as a consideration is a sales-based royalty. From that perspective, you are okay. So on and so. So I think you got to again look at the substance of the transaction to say that, am I extending a financing? Am I extending a loan to a customer? Am I receiving a loan in a way from my customer as a result of this transaction? And hence, if the answer to that is my cash price and my transaction price is substantially different because of the way the payment schedule is agreed between the buyer and the seller, right? These are the things which you need to keep in mind, right? That is this going to be different because of a very specific nuanced payment schedule which I've agreed, or all of this actually reflect the market reality, and hence there is no financing component which is involved in these. These are not structured sales arrangements, so on and so forth, from that perspective. So let's look at a scenario whether the judgment, an entity, commercial airplane, whether it is significant or not, is a matter of judgment. In terms of contract the customer from a promised consideration of 70 lakhs, and then you've just received an advance of 2%, 1,40,000. That's the scenario one. In scenario two, here I've just received 1,40,000, which is 2%, and here I've received an advance of 20%, right? So there's a consideration. In one scenario, I received an advance of 2%. In another scenario, I received an advance of 20%. Whether the company needs to make any adjustment in determining the transaction price is a matter of judgment, right? Now, whether 2% is significant or not, right? You need to evaluate that. Whether 20% is significant or not, we need to evaluate that, and whether then it in excess of a year. Why this question has become relevant? Because this advance has been paid in excess of a year before the delivery schedule will start, right? So to say. So is there a significant component? So you may conclude that 2% is not significant, and hence I don't need to worry. You may conclude that 14 lakh or in a way 20% in this example, 20% is significant, and hence you need to adjust. And again, we will try and understand this with the help of an example, that where I need to adjust it, that how do you actually go about this, right? How do you go about this whole scenario, from that perspective. And this is the example we have, okay, where we will go through some journal entries, right? Where I have received an advance payment, right? And I believe this is significant, right? And this is in excess of 1 year, right? So how do I now make this adjustment, right? So let's look at this question. ST Limited enters into a contract with a customer to sell an asset, the control of the asset will transfer to the customer in 2 years. 2 years, right? Not in excess of 1 year, so 2 years. There are two alternative payments which are given in this example. Payment of INR 5,000 in 2 years when the customer obtained controls. Payment of INR 4,000 when the contract is signed. The customer elect to pay INR 4,000 when the contract is signed. ST Limited concludes that the contract contains a significant financing component because of the length of the time between the customer pays for the asset and when the entity transfers the asset to the customer, as well as prevailing interest rate in the market. The interest rate which is implicit in the transaction is 11.8%, which is the interest rate necessary to make the two alternative payment option economically equivalent. However, the entity determines that the rate that should be used in adjusting the promised consideration is 6%, which is the entity incremental borrowing rate, right? So interest rate implicit between 4,000 to 5,000 is 11.8%. However, that's not relevant, right? However, the entity determines that the rate that should be used in adjusting, because I can borrow money at the rate of 6%, which is my incremental borrowing rate, right? So the question here is, how much is my revenue, right? Even though I've only realized 4,000 rupees, now you will see my revenue is actually different than 4,000 rupees because I have to factor in this financing component. Okay, so I'm going to look at the journal entries. So first journal entry is that I'm going to receive 4,000 rupees. So cash I have received to contract liability, because I've yet to fulfill my performance obligation. Hence, it is recorded as a contract liability. Now, at the end of the year one, I said 6% is the rate of interest. So on 4,000, I'm going to now record interest expense, because that's a liability, that's an expense, right? So I'm going to record an interest expense of 240, and I'm going to increase the amount of contract liability by 240. That's at the end of the year one. Now I'm going to go to the end of the year two. Now on this 4,240, I'm going to accrue more interest, which is 254. So this 254 is nothing but 4,240 into 6%, right? That is what is going to give me 254, okay? And now I'm going to record the revenue when I'm delivers the goods to the customer, which is 4,000. That's my revenue is the contract liability debit now 4,494 and credit my revenue of 4,494. All right. Now, there'll also be a possible scenario to say that whether the interest what you're paying is that interest is eligible for capitalization with reference to the concept which is there in Ind AS 23. That is not a subject matter of this question, but I'm just saying that you may wish to evaluate if you have more facts, more information, for some of this situation, from that perspective, right? Okay, let's look at another scenario, right? Withheld payment, if there are, many times we see, let's say a customer, you're doing a government contract or doing any contract, there's a retention money. There's the money being retained, right? By the buyer, as you keep on raising on invoice, they retain 5%, right? Now the question is that is that something which is a financing component, right? Now that's where I think the assessment under the standard is that if there's a retention money, that's not a financing component, right? From that perspective. So that you don't need to worry, right? ABC Limited entered into a contract for the construction of a power plant that include scheduled milestone payment throughout the contract term of 3 years. The performance obligation will be satisfied over time, and the milestone payments are scheduled to coincide with the expected performance by ABC Limited. The contract provides that a specified percentage of each milestone, say 5%, right? We don't have that information, but say 5%. Will be retained, withheld as a retention money by the customer throughout the arrangement, paid to the entity only when the building is complete. Analyze whether the contract contains any financing component. The answer here is that it has no financing component. This is the customary trade terms. and that's what is required, and there is no discounting. Contract does not include a significant financing since the milestone payment coincide with the performance, and the contract required amount to be retained for reasons other than the providers of finance, the all of that basically, from that perspective. The withholding of specified percentage is intended to protect the customer from the contractor failing to adequately complete its obligation under the contract. All right, that means there is no issue in this arrangement. You vanilla, same plain vanilla, you go and keep on recording revenue as you keep on fulfilling your performance obligation. Let's look at another example of payment in arrears, right? EPC contractor enter into a 2-year contract to develop customized machine for a customer, right? The contractor concludes that the goods and services in the contract constitute a single performance obligation, right? Based on the terms of the contract, it's a 2-year contract, right? The contractor determine the transfer control over time, right? And so we will talk about some of these transfer of control at a point in time or over time, and recognizes revenue based on input method, best reflecting the transfer of control to the customer. The customer agrees to provide the contractor monthly progress payment with the final 25% payment due upon contract completion. As a result of the holdback payment, there is a gap between when control transfer and when consideration is received, creating a financing component, right? In a way. So is there analyze whether there is any significant financing component in the contract or not. So analyze, is there a significant financing component in this arrangement, right? We got to analyze that. So when you look at the solution here, right, there is no difference between the amount of promised consideration and the cash selling price. There is no premium in a way. The holdback only to ensure successful completion, and hence the contractor concludes that this contract does not provide the customer the contract significant benefit of financing. Again, there is no financing which is being involved in this arrangement. Let's look at another scenario of applying the practical expedient. We talked about this, right? If the period is less than 1 year, then you can simply apply, do nothing, and just enjoy. Company H enters into a 2-year contract to develop customized software for company C. Company H concludes that the goods and services in this contract constitute a single performance obligation. Based on the terms of the contract, company H determines that it transfer control over time and recognizes revenue based on an input method, best reflecting the transfer of control to company C. Company C agrees to provide company H monthly progress payment based on the expectation of the timing of cost to be incurred. Company H concludes that the progress payments are being made such that the timing between the transfer of control and payment is never expected to exceed 1 year. Analyze whether there is any significant financing component in the contract or not. All right. Now, there is nothing to be done here. Why? Because again, I have a practical expedient. It will not need to further assess whether a significant financing component is present and does not adjust the promised consideration, as they're applying the practical expedient under Ind AS 115. So we talked about a whole range of scenarios in relation to financing, right? So if there is a financing, you got to impact the transaction price. If you have received advance, it can have an impact. If the extension is less than 1 year, then you don't need to worry. If it is a retention money, you don't need to worry. If it is as per the customary trade practice that, because to ensure performance obligation, you don't need to worry that. So you got to figure out, is there a financing component? Are you actually doing a structured transaction? And if yes, then you got to discount the transaction price to appropriately assess and determine how much is revenue, how much is interest, right? That is why this is important, right? How much is revenue, how much is interest, right? From that perspective. Now let's talk about important concept of non-monetary consideration, right? Non-cash consideration. So you're selling something, and in exchange, instead of receiving cash, you are receiving another asset, right? Another asset or another service, anything you may receive in exchange, right? Sometimes a customer promises to pay for a good or services in a form other than cash, such as shares of common stock or other equity instrument. We see this again in some of these advertising arrangement with some of these leading companies, that you do advertisement. I don't have money, I'm a newly startup, I don't have money, so what do? You do the advertisement on my behalf, and I'm going to give you equity stake in my company, right? So there's a company A, which goes to, let's say, a media agency, and say that, I want to do advertisement, but I don't have money. So you do it, and in exchange, you take shares in my company. Right now, here I have actually transferred, promised, I provided a service to A. In exchange, I'm receiving a non-monetary consideration, which is shares. So how much is my revenue? And the answer to that is you determine the fair value of the consideration which is received, right? When an entity expects to receive non-cash consideration, is measured at the fair value of the amount received or promised, right? And that is like your transaction price. Now, if you are not able to measure the fair value of the consideration which is received, then you try and determine the fair value of the fair value of the services which has been provided to the customer, right? Measured indirectly. If you can't measure directly, measured indirectly by reference to the selling price of the goods or services transferred to the customer in exchange for the consideration, from that perspective. And then in a way, you're going to look at this to say, how is this going to impact my revenue recognition, right? So if that's been the case, you evaluate this, and then impact if the fair value of the non-cash consideration varies after contract inception because of its form. For example, a change in the price of a share, that's a subsequent period adjustment, right? You don't adjust this immediately, from that perspective. So I think that's an important fact, is what you need to look at from that perspective. So if the fair value of the non-cash consideration varies after contract inception because of its form, the entity does not adjust the transaction price for any change. For example, now I have received the shares, I provide the service. Now next day the share price changes. Now that's an accounting I need to now do with the shares. The revenue process is complete. The Ind AS 115 is complete. I now going to account for those stock under Ind AS 109, right? So let's just try and again look at an example of a non-cash consideration. An entity enters into a contract with a customer, right? There's a customer to provide a weekly service for 1 year. I'm going to provide a weekly service for 1 year. The contract is signed on 1st of April, right? There's a date on which the contract is signed and the work begins immediately. The entity concludes that the service is a single performance obligation because the entity is providing a series of distinct services, which is on a week-by-week basis at the same pattern of transfer, right? Time-based measure. In exchange for the service, the customer promised 100 equity shares per week of service. 100 equity shares per week of service. The term in the contract required that the shares must be paid upon the successful completion of each week of service. So every week I am going to make an assessment of the transaction price because the price of the share is changing, as we know. So the entity measures its progress towards complete satisfaction of the performance obligation at each week of service is complete. To determine the transaction price, the entity has to measure the fair value of 100 shares that are received upon completion of each weekly service, right? Each weekly service, the entity shall not reflect any subsequent change. If there's any subsequent change, that I need to deal with this under Ind AS 109. Now, if there is a consideration paid or payable to a customer, what does that mean? Ordinarily, I'm entitled to receive a consideration, right? Because I sold a good or provided a service. But many times I may need to pay to a customer, right? Now, what is it I'm paying it for? If it is a cash credit, a reduction in the transaction price, or actually I'm making a payment to my customer for a distinct goods or service. Now that's where a judgment comes in, or it's a combination of the two. If it is a distinct goods or service, for an entity to treat that consideration paid or payable to a customer as something other than a reduction of revenue, the goods or services from the customer must be distinct. And it otherwise, if it is not, then you're going to record it as a reduction of transaction price. The entity recognizes revenue for the transfer of control of goods to the customer when the entity pays or promises to pay the consideration. Right. So let me again try and help you understand this slightly better. Right. So what are the scenarios here? Let's say there's a company A and there's a company B. Right. There are two. Right. So this is the seller and I have a buyer. Right. I have sold goods worth rupees 100. In exchange, the two scenarios we are saying, a reduction of the transaction price. So am I giving a cash credit? So is A, let's say A decides to be going to pay to A 100, right? But A decides to actually cut a check and give 10 back to the B, right? That means my transaction price or my revenue is only going to be 90. Right. Now there is a scenario where actually B is also providing some service to A. For example, A is being engaged by B has been engaged by A to provide, let's say, courier services, for example. Now for every unit of courier services provided by B to A, B is going to charge, let's say, 10 rupees. Right. Then the question is, is the courier services provided by B to A, is that a revenue reduction or is that a cost, right? Now, and that's where this is saying, if it is a payment for a distinct goods or service, right? So this 10 rupees, the courier services is a distinct good or service. If I would not have taken this from B, but I would have taken this from, XYZ service provider, I was required to pay rupees 10 as a courier services. Then this is a distinct service and hence it's a cost. In that case, my transaction price continues to be 100, but as a 10 is actually a cost of providing that service or sale of that good, and I'm going to record that as cost. Right. I'm hoping that you're clear on what I'm trying to say here. So let's just try and see with the help of an example here. An entity that manufacturer consumer goods enter into a 1-year contract to sell goods to a customer, that is a large global chain of retail stores. The customer commit to pay at least INR 15 crore of products during the year. By at least INR, the customer will buy 15 crore, 15 crores. The customer also requires the entity to make a non-refundable payment of INR 1.5 crores. I've received a non-refundable, I have to make a payment of non-refundable at the inception of the contract, like a security deposit, right? The INR 1.5 crore payment will compensate the customer for the changes it needs to make to its shelving to accommodate the entity products. The entity does not obtain control of any right to the customer shelves. So let's say, you have your shop and now I want to buy your products, but for me to do display of your product, I need to make certain changes into my furnitures, and then hence you need to make a payment of this 1.5 crores. Now the whole question here is that what's my transaction price, right? So is this 1.5 crore which I paid, which let's say, so the two parties again, right, A and B. So in a way, A is going to sell goods, and in consideration, B is going to pay how much? 15 crores. A is going to sell goods, and in consideration, but A is also making a payment of 1.5 crore to B on top of supplying goods, right? On top of supplying goods, I'm also making a payment of 1.5 crore for B to upgrade its furniture, upgrade its shelves so that it can appropriately display my goods, right? So the question is, how much is my contract consideration? Is my contract consideration is 15 crore or actually it is 13.5 crore? So the thing is this for this 1.5 crore, is there is a distinct good or service which I am receiving as in a way a customer, right? The answer to that is no. Then my contract consideration is 13.5 crore, not 15 crores, right? So the entity considers the requirement of Ind AS 115 and concludes that the payment to the customer is not in exchange for a distinct good or services. This is because I does not obtain control of those shelves. I have no rights here. Is nothing but a reduction of the transaction price, and hence I'm going to record revenue of 1.5 crore, which is a 10% discount. So in a way, my contract consideration, entity recognized revenue of, therefore in the first month the entity transfer goods to the customer, the entity recognized revenue of INR 1.125 crore invoice minus the 10% discount, in a way which is payable to a customer, in a way from that perspective. So it is important that if you are buying or selling, what is consideration paid or payable to the customer? If you're buying or selling from the same counterparty, buying or selling with the same counterparty, we need to then appropriately evaluate that, are we trying to artificially inflate revenue of both the parties, or you got to then go into more substance into the arrangement that no, there are distinct goods or services being sold and received, and hence both of them have to be accounted on its own. No, they are not distinct goods or services which I have received, and hence I need to then factor that and appropriately account for it, from a revenue recognition perspective. So we talked about whole lot of stuff, right? We've talked about whole lot of stuff. Variable contract consideration. Why is this important? That so anything which is not fixed, there is subject of element of variability, contingency is what we need to assess. And we talked about different variety of contingencies, like possible, probable, highly probable, so on and so forth. All of that. The variable consideration is subject to constraint. Constraint is a highly probable, high hurdle. It includes to the extent it is highly probable. All of that is what you need to determine. We talked about the financing component that, and we also talked about the practical expedient if it is less than 1 year. From that perspective, there is a buying or selling with the same counterparty. You got to be careful to say that what are you paying it for? Are you paying it for a distinct good or service, or otherwise it is will be construed as a discount or incentive to your buyer? From that perspective, or their non-monetary consideration. How do you evaluate the revenue recognition, which is you consider the fair value of the consideration received, and if that is not clearly evident, then you look at the fair value of the goods or services which have been transferred to the counterparty, and then any subsequent change in the fair value of the non-monetary consideration which is received is accounted independent of Ind AS 115. From that perspective, we also talked about some of the arrangement like warranty type arrangement, that warranty type arrangements are of two types: assurance type warranty and a service type warranty. An assurance type warranty, you provide for a cost, whereas in a service type warranty, the transaction price gets impacted, wherein the promised obligation is a separate performance obligation, and you need to allocate a transaction price to a performance obligation. We talked about retention money, and we said retention money, no problem, that's a part of a performance obligation. It's not a financing component, so on and so forth. So we talked about a whole lot of stuff. We talked about bonus scenarios, we talked about rebate scenarios, refund scenarios, sales return scenarios. The many examples is what we've all talked about in terms of helping you understand and assess that how do you determine the transaction price. So with this, anyway, we've talked about 3 steps. Now, identify the contract with the customer, determine all your performance obligation, and then determine the transaction price. And now I'm going to talk about step 4, which is allocate the transaction price to each of the performance obligation. And in one of the sections, we've done some relative fair value allocation, and now we're going to expand on that, and then we're going to see what are the multiple possibilities which exist within the standard from the perspective of allocation of transaction price to each of the performance obligation in the contract. All right, I'm going to take a pause here.